Hello everyone. My name is Vikas Agrawal, and I'm the founder of AIF and PMS Experts India. So, we are one of the largest platform for alternate investments and portfolio management services. So, basically, we manage clients' money. We are a boutique wealth management outfit, and essentially, we focus on managing clients' money. So what we're gonna do is, at AIF and PMS Experts India, we keep organizing these knowledge-based sessions, and we invite industry experts, and therefore it is called as Ask the Expert Show. So, firstly, I welcome all of you at Ask the Expert Show. With me, I have Mr. Piyush Sharma. He is the fund manager at Right Horizon. He is managing the portfolio called Minerva, Right Horizon Minerva Underserved Fund, and he brings about more than 2 decades of experience on the table. Now, very, very rich experience when it comes to investing in equities, more particularly in the mid and small cap segment. So, Piyush was born and raised in India. In 2002, he moved to US. He's worked with large organizations like Citigroup, as well as Bombay Stock Exchange. So, he's been with equity markets for a long, long period of time now. He has seen a couple of bull runs, bear run, multiple cycles, and developed his own wisdom in terms of identifying ideas at an early stage of their growth curve and able to ride through the entire growth journey of those businesses. So today we thought we'll invite him and read his mind, understand there's this myth about mid-sized companies, and they're not owned by institutions, and should we be investing in those businesses or not. So I thought, who would be the better person than Piyush. So we thought we'll have this session. So Piyush, first of all, thank you so much for accepting our request and taking the time out from your busy schedule and agreed to speak to all our investors today.
Thank you for having me, Vikas.
Yeah. So, as we discussed, that today's discussion is debunking myth around institutionally under owned stocks. So, I would request that if you can share your experience first, of last. I mean, you've spent good amount of time in equity markets, and you've been successfully able to deliver deliverables in the hand of investors. You bring about more than a decade of track record, as far as SEBI numbers are concerned. So I would request you to start with that, your own personal experience. Then we'll come to the topic, and then I would also request you to talk about your funds as well. What's your investment philosophy? How do you select stocks? So over to you, Piyush.
Sure. So I was, as you said, I was born and raised in India. I started my career with Citigroup in global consumer banking in late 90s, primarily on the risk management side. I moved to Bombay Stock Exchange, and we had a small internal economics and research team that used to do a lot of work on market microstructure. So debate and hopefully address issues around price transparency, discovery, liquidity, etc. Moved to the US in early 2000s, and then spent the next 8 years on the institutional investment research side, notably with Sanford Bernstein in New York, where I covered US autos and auto parts, with Avondale Partners in Nashville, Tennessee, covering small and mid-cap consumer products names, and with Longbow Research in Cleveland and in New York, covering business services. And I started working on India, say, right around the financial crisis, so call it late 2009. Worked on the idea throughout 2010 and started allocating capital to India in early 2011. And the idea, Vikas, back then was that I have the fortune of covering the mega caps at Bernstein and smaller names elsewhere. And I'm now talking, what, 17, 18 years ago. But even back then, I do not ever recall looking at names 100, 200, 300, 400 million USD market cap that wouldn't have institutional coverage, and institutional ownership will be limited. It simply doesn't happen here. Um, Almost everything is institutionally well owned. You might argue whether something is over owned or not, but institutionally under owned is something in US just simply doesn't happen. So even if you look at these small names, you'll have a Siroti in Long Island or JMP in San Francisco or Avondale, Longbow. Just about every city here will have a lot of institutional caliber institutional focused brokers with institutional caliber research. And you look at India, and it's absolutely bizarre how the market microstructure is. On one end, you've got Nifty 50. Many people may not appreciate this, but your 50 biggest names in India have more sell side opinions per name on average than even Dow 30.
True.
So Boeing's and Bank of America's and Disney's of the world, believe it or not, are less institutionally covered than our Nifty 50 names. And the bizarre thing is, in that same market, you go across and you look at 100, 200, $400 million names, and institutional coverage is scanty to insignificant, just not there. And
True.
institutional ownership ranges between whatever earth shattering 1% to call it 10%. Floats are low as well. But the beauty of that market is that, and again, we can hypothesize about this all day. Um, but the fact is, for XYZ reason, we are culturally wired to associate size and quality. And practically our largest companies can get away with murder, in my opinion. And you've got smaller names that just cannot catch a break. I mean, corporate governance and quality, etc., etc. You've got tons of questions coming up. And it's a very, very broad market, Vikas. Actually, it's an impressively broad market. Again, something that a lot of Indians may not appreciate is you look at MSCI Emerging Markets Index. And MSCI Emerging Markets, India will be whatever, I think 14, 15% weight today. But there's another index, not as closely watched, which is MSCI Emerging Markets Small Cap Index. India is not only the biggest weight of that index, more than quarter of that index is just India. So India is an impressively broad market. Uh, but yet, in such a broad market, for XYZ reasons, as I said, the focus on quote unquote quality that we will discuss later is just way too much. And on the other side, you've got a lot of opportunity. So we thought back then that this is a space that, given my background of doing more institutional caliber stuff on both small cap, mid cap, and as I said on the Bernstein, Violet Bernstein mega cap as well, that is a space that is absolutely ripe for investing in India. Because in such a broad market, there is no good reason why you cannot create a book that is cleaner, growthier, and comes at fraction of a price of institutional street darling. And so we started allocating capital in India in April of 2011. So you're right, coming close to now 12 years. Um, we've delivered, again, custodian numbers come up every day, but my guess is at CAGR today would be a headline about 19%.
Right.
But the important thing is that headline number uh, is based on a launch in 2011. What else happened in 2011? The worst year for launching an India specific strategy. If you look since the global financial crisis, Nifty lost more than a quarter of its value. Mid caps lost a third of their value. Small caps, if I recall right, lost more than 40% of their value. It is just a horrible year. So when you see that number, as CAGR only tells you the start point and end point and leaves everything in the middle. And at least individual investors, need to do much more work on what happened in the interim. But anyway, so that 19% number really is because where we started, and despite that, we've done about 8% annualized alpha versus Nifty, 7% versus small caps and mid caps in a very, very consistent manner.
Right.
So yeah, so I think that's a little long drawn on my experience, but yeah.
Yeah, but there's this perception, Piyush, that in India, most of these small cap companies are not well governed, or they are ethically not strong. Their balance sheets are manipulated, and we keep hearing this noise from number of people, those who are reputed, in terms of managing large portfolios. What's your views on that?
Can I share my screen here very quickly, because
Please, please.
uh, This is viewable, I'm assuming.
Yeah, very much.
So, okay, let me just quickly address a couple of things before we get into these this issue of governance. Um, Firstly, whenever you are investing in a new strategy, a new manager, a new asset class, two things are critical. You have an efficient frontier which has got returns and volatility. So either your returns need to be higher for the same level of volatility, or for the same level of return, your volatility should be lower. Either or, ideally both. If you're not getting that, you should not be investing. Within the space that we invest in, we've not only got incrementally significantly higher returns, but more importantly, we've done that at volatility levels that most people will not associate with this group. Let me quantify this. While I gave you a headline number, and a lot of people focus on those headline numbers, and honestly, they shouldn't. Uh, Again, I'm not trying to missell myself. We've got solid numbers, but the fact is, you cannot look at numbers and you cannot view that without taking that in conjunction with associated volatility. You look at our volatility, and our volatility versus BSE small cap is almost 3 percentage points lower annualized over the last almost 12 years. So not only have we delivered numbers, we've delivered numbers at volatility level, as I said, which are not typically associated with this space. The second point that I would address very quickly before I get into the addressing the myths are, look, it's a very twisted math, because SEBI says all you need to float in an IPO is 25%. That's about it. Now, imagine 100 million or even a $200 million name, $50 million floated as market cap. If you think, first of all, look at how India's market microstructure looks today. Almost half of daily trading is retail. If I look here in the US, even today, when retail trading is elevated, 80% of the trading will be institutional. India is primarily a retail driven market. What does retail look for? While everybody looks for validation, retail looks for validation even more. And when you're looking for validation, what is comfortable with you? Something that is visible, something that you can directly associate with, that gives you comfort. That comfort comes at a very expensive price in case of India. Now think of a large sell side firm doing institutional trading in Bombay, Bangalore. You're hiring a guy to cover, God knows, 10, 15, 20 names. And you've got an institutional desk as well. My guess is a decent analyst between fixed and variable will cost you a crore. Then you've got an institutional desk, and you've got sales guys there banging their table every day by calling institutions on what to own, etc. You do the math, and you would realize that it does not make sense for them to own anything which is small in a market that's primarily retail. Now, if there are more institutions that engage, and this happens at a very gradual pace. So when we launched, India was not as institutional as it is today. It has become more institutional. And as it becomes more institutional, more people like us engage, then suddenly you would see more sell side people engaging too. With more sell side people engaging, you'll have more research. When you'll have more research, you'll have more visibility, and therefore, you would see people coming up with research on these names. Today, sell side will sell you what is easy to sell. They're not selling you what is the right thing to sell. They'll sell you what is easy to sell. So large quality in India is easy to sell, and so it's the math works that way. Now, coming quickly to now just the myths. You said why there is a prevalent notion in India that large companies are good and small companies don't have the same governance. Let's start with the first one, quality, right? As I said, quality. I turn an Indian television channel on or pick any of the media outlets. Quality as a word is always used in conjunction with size. Every 2 decades, Vikas, 40 to 50% of Nifty 50 components change, roughly. If
True.
I just if I just look since the financial crisis, I've got a lot of quote unquote quality leaving that index. Unitech, Satyam, Balarpur, Crompton Greaves, Yes Bank. It's a long list. Um, Maybe we are culturally wired to think in a particular manner. As I said, in a validation starved world, sell side does its job to ensure that we think in a certain manner. But the fact is, Indian large cap, let's call it the hallowed then thou set of Nifty 50, at a very alarming rate picks up lemons. We may have a selection bias and we may not think about that, but they keep on picking lemons at a very alarming rate. But we generalize, and we generalize in a manner that's literally apples to peaches. You've got a very small set of 50 names, let's call it even 100 names, a very small triangle, and we compare that with a very large trapezoid at the bottom, which are your small and micro caps. Because as I said, India is an impressively broad market. So while it's true that I pick Nifty 50 and I can come up with quantifiable metrics associated with corporate governance, accounting clarity, and it's true that I might say that Nifty 50 is cleaner on average versus mid caps, which are then cleaner on average versus small caps. Here's the problem: small caps is a massive trapezoid. You cannot compare that with a very small triangle on top. Uh, so there's no good reason why you cannot own 15 to 20 names in India. In fact, I would flip this argument right now. Not only are they as clean, we argue the book that we've picked or we've picked for last 12 years is not just as good. We argue it's cleaner than Nifty 50 at a fraction of value of Nifty 50. Second thing that again you would have heard and you keep on hearing every day within Indian media is the word pricing power. Probably the most overused term I hear there. And again, people will draw narratives whatever they can to support stuff. First of all, pricing power is a very utopian concept. What is pricing power? And technically speaking, you'll say pricing power, your ability to influence pricing without impacting demand. In real world, you don't see real pricing power. Nothing is so price inelastic. I mean, even industries and spaces that you think are very inelastic really aren't as inelastic. So just to give you an idea, we were
Based on the
recent.
leadership, what they talk about, isn't it, Piyush?
What is that? Sorry.
Based on the leadership, based on their size, the
Correct.
leadership. So if the leader moves the changes, for example, Maruti is the leader in auto segment. If they decide to change the price, the eventually other players follows the trend in India.
That may or may not hold true. That may or may not hold true. I mean, Maruti, you picked up a space that's. I mean, it's probably the most mass OEM of sorts. And again, we might be diverging, but the most expensive model of Maruti, I think today is XL6, and the the highest version of XL6 with all bells and whistles would be retailing for, I don't know, I'm not checked, but probably close to 15 lakhs. So it's a very mass OEM. I'm not sure I can compare that necessarily with today's Tata Motors, for instance, a heavily SUV, incrementally much more SUV oriented OEM, or with Mahindras or with several others. But so you can compare that, but largely what I was trying to stress upon is the idea of pricing power is, look, you've got these set of businesses uh, that have the ability to pass on pricing pressures whenever they choose to do so. It's a simply utopian, pardon my French, nonsensical idea. It just simply doesn't happen. Just ask businesses that have very sticky consumers today. Ask Ferrari, ask Yeti tumblers in the US. Ask Ralph Lauren. Last year or so, if there's been one time that you had to demonstrate pricing power, it's been in the last four odd quarters when you've seen cost pressures that are largely unprecedented. If you've not demonstrated pricing power in the last four quarters, you have no right to talk about pricing power. So when somebody says that a paints company will have a pricing power, I would have a problem with that. When somebody says a company is selling flip flops, I will, again, you know that we don't discuss, debate, disclose our holdings. So I would resist talking Indian names particularly, but you would know what names that I'm talking about. There is a paints company. You've got a company that makes flip flops, whose average realization on that flip flops will be 150 odd rupees. Your company that makes bakery items, a lot of biscuits, where almost half of their revenues come from SKUs priced at less than $100, less than $50 even. Ask those companies at a time when the bottom of the pyramid has struggled globally, look at how much pricing power these companies have had. But last 10 years, these are the kind of companies that people have been saying do have pricing power. So either pricing power has suddenly evaporated, or what I'm saying is they never had one. If Ferrari doesn't have it, Ralph Lauren doesn't have it, Yeti tumblers don't have it, certainly a paints company or a company making flip flops or companies selling biscuits at 15 rupees don't have it. Let's please understand this bit. If you're talking about it, I would associate this with, think of you having a big punching bag in your basement and you box really well on it. But you've really never boxed in a match. You've never stepped foot in a ring. That's what pricing power in a lot of these companies have. If there's one point that they had to demonstrate pricing power, they did not demonstrate pricing power. So again, another huge myth about pricing power. Third thing, again a myth, is that these large companies have earnings safety during down cycles. Whatever we've seen within the last year, this is a down cycle. This is undeniably a down cycle. Let me share this very quickly. This is since March. This is how EBITDA estimates for fiscal 23 have moved since March. On your left is our book. On the right is Nifty 50. YTD, our estimates have moved up by about 16%. 16%. And we are, again, you look at my weighted average market cap today is about 450, 500 million USD. Median is even much less, about 250 million USD. Now compare that with hallowed than thou Nifty 50, excluding financials on your right, decreased by minus 2%. What I'm trying to impress upon is that this whole view that that these names, give me 1 second here. The whole idea that these names, excuse me 1 second here, I just lost my last, because pardon me for 1 second here. Anyway, so that's on the estimate side. This this whole view, as I said, about perception around earning safety is simply untrue. I think third thing I would address on the myth side is, one, as I said, as I can demonstrate here, the whole idea of pricing power is utopian. The whole idea of earning safety is utopian. The third thing is, even if there was safety, and you could see here that there's really, you don't see safety here. But even if there was this hypothetical safety, at what price do you get the safety? And if you are buying a paints company or companies that make shampoos and soaps at 60, 70, 80 times earnings, understand that we living in a very, very twisted world. First of all, if you just simply look at earnings growth, so Nifty 50 staples components, and if I look at last 6 odd years, on an average would have reported compounded earnings growth of about 14 odd percent, roughly 14, 15 odd percent. The price CAGR of these names over the 6 year period is about 23, 24%. There's a 9 percentage points differential between earnings and price. If I do the math correctly over a 6 year period, that would reflect into a 70% expansion in the multiple. Let that sink in. 70% expansion in multiples. What do you think is going to go? What do you think is going to happen going forward? You'll see another expansion on top of our already very, very elevated base. I would argue that it's not only are you more likely to see significant multiple compression, one thing is clear. In fact, one thing is almost near certain that you're unlikely to see any more multiple expansion from these very, very elevated levels. So, what will you capture? You will capture earnings growth, which is not stellar. But let's say hypothetically, if you were to get multiple compression, what's going to happen? First of all, these companies are not as growthy as they made out to be. Secondly, hypothetically, if they were to grow at 30%, which is twice where they've grown previously for XYZ reason that I cannot reconcile right now, but let's say you grow at 30% over a decade and multiple contract by 70%. If a math is right, you end up really capturing about 15% growth. That is assuming that's a very, very stellar earnings growth with 70% multiple compression will get you about 15% annualized return. So again, if you were to think of it this way, you're getting a contract to clean the facade of a building, let's call it $100,000. You're not going to buy insurance worth $120,000. You're a bank, you want to deliver, originate a loan of, let's say, $100. You do not originate a loan of $100 and provide $70 on it. If you're providing $70 on it at outset on a loan of $100, that's not a loan you should be making. So eventually everything has a price. First of all, as I've argued here, a lot of these large names, the whole idea of safety is one, it's utopian. Two, even if there was safety, even if there was, there's a price to it. We need to question that. In this case, you've got prices at levels that if that's the price of safety, I would not buy safety. So I think those are some of the most critical myths that I would. Let me just very quickly show you how we look on the valuation side, just to give you an idea. And we essentially investing in the same market. This is EV to fiscal 23 EBITDA. Nifty 50 excluding financials on top left. We are on the right. Your top row is absolute EV to fiscal 23 EBITDA. Your bottom row is how that multiple benchmarks versus its pre-pandemic history. So Nifty 50 excluding financials end of October was trading at north of 20 times EBITDA, fiscal 23 EBITDA. We are investing in the same market on right at 7.5 times EBITDA. Bottom is just showing you premium or discount versus pre-pandemic history. Nifty 50, unsurprisingly, is trading at about 25% premium versus pre-pandemic history end of October. We were trading close to 25% discount. It's almost a mirror image. So again, you cannot not think about what price you're paying. And I would say, as I said, this one, you have to question safety, and two, even if there was any safety, there's a price for that safety, and I'm not sure it makes sense for you to pay that price for these very very large names. So I spoke about quality. Now let's very quickly talk a bit about governance. I wouldn't name companies here. A very very large conglomerate in India, very large conglomerate. Last time I checked, at whatever 150, 200 subsidiaries below it, maybe another 100 step down second degree subs beneath that. Every year, you would, I mean, just to give you an idea, it's auditor who I wouldn't name. My guess is we'll have about 100 people doing annual audit for about 3 months, 2 to 3 months there. And these are guys on the inside. If I were to give them a 10% margin of error to tell me confidently where they think the tangible book value of the business is, I would reckon that they would struggle. We're on the outside looking in, and as I said, if you think you can establish accounting clarity in some of these names, then all I would say is this: good luck, because I simply cannot. We invest in businesses that have cleaner structures and quantifiably are cleaner than Nifty 50. So if we can jettison this fluff around corporate governance and instead ask hard, pokey questions that are quantifiable, these names that we own might be smaller. These are all market leaders. They're all market leaders in specific niches. Coming back to your example of Maruti, Vikas, Maruti is a very, very large OEM. Maruti, let's say today, has about 35-40% of India's passenger vehicle market. We own names. Again, I wouldn't name the part, but the specific part where they might have 50% share of that market. A very well entrenched share, might you? But that particular part, realization on that might be 3,000 rupees. While Maruti's average realization, let's say 6 lakhs. You do understand why one is a large cap and one while the other is a small cap. The extremely lazy generalization that large caps are all market leaders are comparable to small caps. I'm comparing apples and peaches here. These are both market leaders. I would argue that the other is very, very well entrenched. And has demonstrated much better earnings growth. Not only that, we were talking about pricing power. Within the last year, some of these names, we argue that in a year like fiscal 23, with half of the fiscal still left, we just might have a book that in a year like this would be reporting margin expansion, significant margin expansion in a year like this, when Ralph Lauren doesn't, when Ferrari cannot, when Yeti tumblers cannot, when Louis Vuitton is struggling. Some of these names, for unique specific reasons, will report margin expansion. A lot of these large, well-entrenched names that individual investors will find much more relatable will be struggling. So yeah, again, corporate governance is a very lazily used term, and if you were to quantify, you might be able to find names that I said are cleaner, growthier, and on your screen come at fraction of the price of Nifty 50.
Okay, sure. We got that. So, can you talk to us about your fund and how long you've been running this in India, and more particularly the official track record of Right Horizon Minerva Underserved Fund, and also talk to us about how do you select stocks and what sort of returns one can expect if somebody is investing in your fund. These are 2-3 questions. If you can take them one by one.
Yeah, so let's take them one by one. Firstly, your first question was around the track record.
Yeah, under the right
So
horizon umbrella.
so under the Right Horizons umbrella. So look, we run an offshore fund out of Mauritius. PMS. We've been associated with Right Horizons since 2016, so coming close to 6 years, or might be 2015. So 15 or 16, so 6 or 7 years. This is the only strategy that we run, which is the institutionally underowned, orphaned, listed part of India. So that is there anything more on the track record specifically that you had, or just the longevity of it?
Yeah, so longevity in the sense that one is of course longevity, the other one is how it has behaved in different markets. Like for example, during 2019, 18, 19, when we saw mid and small cap butcher down to large extent, the valuation gone down as high as 50,
Hmm.
60%. How's your PMS portfolio behaved and delivered returns?
So you said 2009. We were not there in 2009 because we launched in
2018 and 19,
18 and 19. Now, if I look at 18 and 9, now we tend to do particularly better during periods of drawdowns. And let me share this very quickly here.
right?
If this is visible, this is the list of all the drawdowns that BSE small cap has been through since our inception. The drawdown here is being defined as 2 or more months of a decline in BSE small cap, with the cumulative decline being more than 1%. As you could see, if there is one thing which is near certain, is that we do better during periods of drawdowns. That is not surprising, Vikas. Why is that not surprising? Uh, because we steer clear of street darlings. So when street darlings end up doing better during periods when liquidity is a tailwind and everybody, your next door neighbor and the dog walker, are doing well, you would see us taking a back seat. But while the lifting tide lifts all boats, when the tide turns, a lot of them capsize. If you are willing to look like a chump during a period when math doesn't make sense, and you are on the fence, during periods when liquidity gushes out the door, it will not be a headwind for you. So you're not going to get hurt. Think of it last year. If you own Tesla or AMC or Sundial or Bed Bath and Beyond in the US, a lot of these meme stocks, you would look like an absolute genius by the end of 2021. Please understand, there will be 2022 as well. You'll not escape that. And that is where we do particularly well. And I thank you for asking this particular question. Why is this important? Because in fact, I think it is incredibly important. Even though you get a lot of attention because of years like 2021, I think we were up 92% last year or something like that. So pre-Quinn and Allocator and globally across all of these platforms, there's a lot of limelight. I'll tell you what, you need to not look at these years when markets run up a lot. And the reason is quite simple. It is more likely that during these periods you might find investors running up numbers. So it is easier for you to find a mediocre manager running up large numbers in a year like 21 or 17 or a 14. In fact, let me just show you a skewness document right here. But it is very critical that you take off these years away when you're looking at a track record, in my humble opinion, because it is not very likely that you'll see a mediocre manager running up great numbers in years like what we are discussing here, which is when prices are just not running up. In fact, when you see periods of very sharp drawdowns. So what this exhibit is showing you is that while there's a headline number, and again, we are in an industry where I'm not ever preach that you look at a 21% and you think 21% is higher than 18 or 18 is that much superior versus 15. That's a very, very naive way of looking at things. In fact, especially in a business where I would say almost half of your headline numbers are replete with randomness. And therefore, it is critical that you take off these large years outside and then look at how the residual looks. So what we've done here is we've taken the three big years since a launch almost 12 years ago out to see if our numbers are skewed because of those big print years. 17, 14, and 21 in that order. On your left, while we've delivered a headline annualized alpha of say 7%, we've done about 21% last decade. We're up again, we close to 21% this calendar year. We're up 92% last year, up I'm guessing about 42 odd percent compounded last 3 years. So but this 18% year is since our inception. Remember, inception is 2011, very, very critical. But if you start taking off the best years away, which everybody should do, you take off 17, 14, and 21 in that order. You take off 17, we're still compounding in the high teens, while BSE small cap drops to mid single digits. You take 17 and 14 away, we're still doing high teens. BSE small cap is barely compounding in low single digits. You take the three best years away, the remaining almost 9 years, BSE small cap has been losing you at about minus 3%. Nifty, for quantification here, is slightly less skewed. Slightly, I would add. Then minus 3% might become zero, but that's about it. Nifty is fairly skewed too. So it is very, very critical that while you're looking at numbers, um, you need to definitely think about our drawdowns, which we discussed here, and definitely look at skewness. So we a slightly long drawn response to your question, but
Sure.
during period
That's okay. Yeah, I understand. So,
yeah,
couple of quick questions. So, keeping in mind that we have time constraint now, and
yeah,
there are a lot of investors who have joined, and I received a couple of questions in
right,
advance from you guys. So,
sure.
quick question. So, one is the how do you so how many companies are going to be there in the portfolio that you construct?
Typically, we've moved over the last 12 years, where we've moved between 12 to 18 names. I do not recall ever owning more than 18 names. Let's call it the sweet spot of 15 names. Today, we own about 13. We've exited two within the last month. Last year or so, uh, our turnover for every 100 rupees worth of purchase, we've sold about 106 rupees worth of securities. We've been net sellers, which is typical. During periods when you would see markets doing well, you would see us being net sellers. During periods when it's not doing well, people are buying, we generally, more often than not, will be going the other way.
Okay. And what's your deployment strategy? Like if somebody is giving you a mandate of 50 lakhs, you deploy same day or you take your own time or how do you do it?
So, because we don't engage in timing math at all, because I've been doing this a good part of 2.5 decades across industries, geographies, and capital structure, and I can tell you this is it's a myth that you can time. And so the only reason we straddle, and we do straddle, the only reason that we straddle our allocation is because of impact cost. You do not want to throw too much money in a very, very short period of time at some of these names, which is the only reason that we straddle. It has nothing to do with timing. So I would say generally allocations are done over a period of 1 to 2 weeks, typically.
Okay. And what is the time horizon one should look at before committing money to you? Like at least 3 years of time frame, 5 years of time frame, or you look at 7 years is a good time frame to look at minimum.
I would say 7 years is a good time frame. Why I'm saying 7 years? The reason I'm saying 7 years is because it is likely that in over a 7 year period, you will see a period of large drawdown. You would see a period of large run ups. It's a fairly long period. You should also understand that why didn't I say 3 or why didn't I say 5? There's a reason. When you're investing in poor price discovery markets, emerging markets in general have poor price discovery. But within spaces that we invested, I would argue price discovery is relatively poorer. And that is why you have to look focus on the dog and not the dog's tail. So if you can, so first of all, if you're investing in this space, in my view, you need to switch yourself off from that soap opera that starts at 9:15 every morning and ends at 3:30. If this is something that's very hard for you to do, you should not be investing. As simple as that. But if you can shut yourself off from all of that noise and keep your singular focus on underlying earnings of a company, then you should invest. And then you should be investing for a good period of time. If you're typically, I would say 70% of time, if you're right on earnings over a 5-year time frame, you will be right on stock price. That number will go from 70% to 90% over 7-year period. And if investing for a decade or more, you're right on earnings, you'll be right on stock prices. As simple as that. And you need to be right on earnings. You will be right on stock prices. So you need to focus on the dog. And if you're focusing on the dog and not dog's tail, give it 7 years. Please understand this as well. No investor globally, none, zero exceptions, will underperform. There will be a period when strategy will underperform. You just need to understand this. If you're investing for long term with a manager, if you can cut size your investments into 3-year rolling time periods, if you have somebody who beats his or her benchmark over 55-60% of the time, and when they beat the benchmark, they beat with a higher differential. And when they underpace the benchmark, they underpace the lower differential, you will create alpha. If you want to outpace the benchmark all the time, you are living in a utopian world that does not exist. Effectively, you would be simply chasing the dog's tail, or the dog will be somewhere else.
Understood. Understood. Well said. Well said. So basically, that's a style of small cap investment. So
I would say that is style of emerging markets in general, emerging markets small cap in particular.
well said. And that is where I whenever I speak to any of my investor, and I keep talking about this. They come with an expectation of 30-40% returns, and but then they're not comfortable with this kind of volatility. And that is where the lot of accidents takes place. And I've been talking about this ever since we started this platform, AIFPMS.com, that when you're giving mandate to a portfolio manager, the minimum time frame that you should be looking at is 5 years,
Hmm.
you know,
Hmm.
and allow the portfolio manager to take his own call. And there are times when call can go wrong also. There are
Hmm.
one or two calls which can go wrong, but eventually what you need to examine is that how is the portfolio position, what you talked about, return expectation versus earning expectation, and the
Yeah.
actual earnings in the
Yeah.
portfolio.
Yeah. Yeah. Vikas, you brought up the point of volatility. There is something very important that I wanted to address. Can I address it very
Yeah,
quickly
please,
within
please.
the next minute?
Yeah, yeah.
So again, look, I come from a background of investing in the US primarily before I started this, and here and globally, you would see that people often say that stock prices are eventually a reflection of underlying earnings. That is true in good price discovery markets. That is not true in emerging markets. Think of it this way: you look at Nifty 50 today. On average, Nifty 50 constituent will have 50-55% free float. Majority of that free float, or at least half of it, is in the hands of FPIs. Good portion of that FPI capital is just algo capital. There's no somebody picking that. It's just passive capital, ETF focused capital, most of that. Then of the remaining half of the float, good portion is DIIs. So you don't have a lot of individual investors owning these. When you're investing within small caps where institutional ownership is lower, please understand volatility is not always a function of underlying earnings. It's a myth. That's another huge myth. Look at this. These are 6 industries that make today almost three-fourths of a book. We ran this exercise over 2009 to 2019 where we looked at the frequency of earnings declines within these companies, and on the right side the price volatility, and we compared them versus large global peers. So let's say we hold a PVR. We'll compare PVR with with an ODEON or an AMC, but let's say large peers. We're looking at paper, for instance. We'll take our holding and we'll compare them with the Weyerhaeuser and UPMs and international papers of the world. We have beverages. We'll compare them again with large names. But the point is, you look on the left. The frequency of earnings declines of our holdings over 2009 to 2019 period, 27% of time our holdings showed earnings declines in a given year. So every fourth year, roughly. That number was 36% for the comparable large global peers. But on the right, we look at annualized price volatility. And vol is higher for our names versus the large global peers. Please understand this. This is here you've got ticker tape that is not a reflection of underlying earnings at all. It's a reflection of ownership, specifically institutional ownership. So while again, I would go back to the same thing about dog and dog's tail. The tail does not wag the dog. You focus on the dog, don't bother about the tail. Switch yourself from the soap opera of 9:15 to 3:30 that's on the right. On the left side are earnings. Focus on earnings. Give it time. Give it if you're right on earnings, you will be right on stock price. It doesn't work the other way around.
But how do you bring
So
the conviction on the table, Piyush here? I mean, one is that you're not looking at the market outcomes, you're not looking at the earnings because you only see the visibility. Let's say the earnings are going down for 3, 4, 5, 6 quarters. Then
yeah.
how do you bring that conviction on the table? How do you build that wisdom of making money out of that? Because the number of accidents which takes place in this segment is very, very high.
Again, very very large trapezoid, Vikas, massive trapezoid. We barely are looking at 15-20 names here, and I showed you here for all the talk of failures, etc., etc. Nifty 50 picks up these lemons with alarming regularity. We do not. Nifty 50 finds it harder to find pricing power in a year like this. We don't. So do not generalize. Um, but coming back specifically to your question, let's say hypothetically, and we've not been on their side, our earnings this year will be reporting in FY23 as I stand. I'm expecting north of 30% earnings growth. Nifty 50 will struggle to do double digits. With all due respect to the Lal Street's very, very sanguine outlook for FY23, I do not believe we'll be doing double digits on Nifty 50. And if we do, we'll just about do it, excluding financials, of course. We'll do north of 30% this year in a year like this with margin expansion. But hypothetical question, you said if I had a name hypothetically where I go for 4 to 6 quarters of earnings declines, you need to first question, is it structural or it is something that's one off? I've been on that side where we've been wrong and business generally was wrong on something, but it was not structural. I've been on a side where it was structural. When it is structural, you need to think hard whether you want to own something like that because your thesis right now is being questioned. But if your thesis is intact and it's a one off short term thing, I've got no problem. In fact, if market sells it, even better because I'll take advantage of that. So it again, not you cannot box everything and have one answer to it. You have to question whether it's structural or not. But I would just caution that let's not even start having that argument on a small cap versus large cap versus mid cap level. Ask questions of a business. We own auto parts names. And since January or February is when container freight rates peaked. And since then, we've had almost 9 months of sharp declines. But going back 3 quarters towards, let's say, even more, let's say towards the middle of 2021, and freight rates are very, very extreme. Uh, we had an auto parts holding that was moving 40-foot containers from Kandla to the Gulf Coast in the US. And the landed cost, 60% of the value of the container was just freight. 60%. All of that was being paid by the OEMs that were sourcing this particular part. That's pricing power. When you have a forestry name that makes paperboard, and paperboard in general, a large pharma company, I'll just give a specific area, Baddi, for instance. Now, Baddi, is a hotbed for manufacturing. A lot of consumer staples guys are there. A lot of pharma guys are there. You got paperboard guys going to these pharma and consumer staples companies saying, take 30%, 35% of YOY increase in price on paperboard. Otherwise, it will be very hard for us to supply you paperboard. That's pricing power. Uh,
So last 3 minutes to go, Piyush. Over to
sure,
you.
sure. So yeah, I would say that look, just we already discussed about the myths. Say it's very critical what kind of traits you have. Patience becomes extremely important. You need to focus more on the underlying earnings than on the headline stock prices. And I'll say finally, even a bit in terms of measurement, when you're measuring any number, um, do not look at headline numbers. Headline numbers will hide more than they will reveal, or at least reveal as much as they will hide. So it is very critical for you to adjust for skewness. It is very important that you focus on periods of drawdowns. But other than that, if you can always engage your discussions around underlying earnings of companies, there is no good reason why you'll not be well off. And as yeah, I would say that's it's patience, patience, patience. But again, I'm not just harping on this. Don't be patient about earnings and cash flows. I get that, but be patient on headline stock prices because they will move, and you will not always pick the bottom because most people that I speak with, large upsides resonate with them better. So when I tell somebody that, hey, I was up 92% last year, that soundbite you pick very easily. You can associate with that very quickly. You should not. You should not. The real alpha does not get created in a year like 2017. In fact, let me just very quickly show this if I have it. Um, I don't have this open, but the real alpha is not created in years like 21, 14, and 17. Unfortunately, that's when a lot of attention comes in. That's when a lot of allocation comes in. Please understand that we are all human. You're human too. You have to participate in downsides to grab upsides. It's not either or. You will get downside and you'll get upside. Invariably, in my opinion, your big alphas are created during periods of downside. That is, you do not fall less. Again, this will not resonate very well, but this is true. When you fall 15% and market drops 30-35%, this is where really the source of alpha is versus going
So,
up in a year
Piyush,
like 20.
yeah, sorry to interrupt. So wouldn't it be a good idea to add more money during the downturn?
If your thesis is intact, there is nothing that is structurally changed in the business, valuation is solid, but just simply out of sentimental noise, price is drawing down, undeniably throw kitchen sink at it.
Correct. This is what I advise all my clients that whenever you want to add money, don't add during the good times. Always look out for. You will always find some of the other reasons in the markets when you see some amount of downturn, maybe because of external affair. You know,
Always.
uh, so that is the time you should be giving more money to the portfolio manager if you have knocked down and zero down on one particular manager. So
Yeah, I
that's
mean,
how it is. So we are running short of time now, only 30 seconds to go. So I want to take this opportunity to thank all our investors for supporting us